Okay, well, welcome back to another episode. I watched you, Kevin, last week with David, and I was so enthralled about having you again. So I decided to have you back to our podcast. So Kevin from APS Mortgage Team is decided to come back for a second time. So maybe for the folks that didn't see the episode last week, tell us a bit about yourself.
Yeah, my name is Kevin. I'm part of APS Mortgages. We are a team of 6 agents, and we're a very high-producing team, and we have a really great relationships with all lenders, have great solutions for all types of clients, whether they're business for self or they're working a T for a job, for investors. We have solutions for everybody. I'm also a real estate investor and a developer as well. I'm working on a project right now, and it looks like it's going to be very close to completion by the spring of 2026. So I'm excited for that.
Excellent. And the thing I like about Kevin is the fact that everything's about team. And, the TF team and Kevin and his team. So that's why I like the synergy between us, and which is timely. Could I afford a home in 2026? So if I'm a first-time home buyer, do you think I could afford a house right now?
It's a good question here, because where we are at today, we're probably in a very suppressed state in the market. Hence, the prices are in a good place for buyers right now. Like you see the headlines, condo markets crashing, homes are, appraisals. I've seen this since 2024, like late 2024 till now. Appraisals are coming back short for pre-constructions, right? So it's a good time for buyers if they're able to scrounge up a down payment. They have a stable income, credit's great, debts are not crazy high. Start looking. It's just a matter of whether these sellers are willing to let go of the price.
That's true at that
price, right?
Yeah. I mean, we're seeing now home prices in the GTA for the first time below $1 million, right?
On average, that's what they've been saying.
Yeah. So it is, I guess it's a good time. So what do I need to buy that house? If it's now below $1 million, I guess I need a down payment, but is there anything else that you could think of that I should be aware of?
Yeah, absolutely. I know for a fact that everyone's always looking at the home prices, and it's very high. And we're talking about where we are in the market right now as being a good place to start entering in. Keep in mind too, seasonality, spring market's coming up. So there could be more activity. After daylight savings is that 7 p.m.
My driving sucks, but buying a house is a good thing.
That 7 p.m. in the winter is not the same 7 p.m.
That's
now.
right.
So those walkthroughs, natural lighting that goes through is going to look a little bit better. So I would say keep this in mind. Whatever your income is, your job is, try and, I'm not saying like stay or don't stay. If you can work in the same industry and have a better paying job, you can definitely pivot and do that, because it's in the related industry. But if you don't like your job, don't think about leaving just yet, because you definitely do need your job. And obviously, down payment is always a challenge. You can get gifted funds from your immediate family, like your parents, mom, dad, sister, brother. It can't be from like an aunt or uncle or distant relative or a friend. That's not allowed. But gifted funds that cannot be returned, because that's an extra layer of life. It's a gift, right? We don't return gifts, right? So if you do, that's not really a gift, right? I know that's a reality for most people, first-time home buyers specifically, because a lot of equity from parents is first, they're not just their first home, but their primary residence or whatever, has built up a lot of equity over the years. So that's a source. Savings. We haven't talked about this yet, but the FHSA, right, the first-time home buyer savings account, right, that is important too, because there's a maximum of $40,000 that can be contributed to that account, and then $8,000 maximum per year contribution, which can be tax deferred, right? It's kind of like the hybrid between TFSA and RRSP.
Exactly.
So that's important, because any sort of profits or gains from that account could be contributed towards your down payment.
Yeah.
So we have options. And then we also we haven't talked about this yet either, RRSP.
The home buyer's plan,
Right?
that's right.
Borrowing up to 60,000 and then using that as down payment, but returning it over the 15 years.
That's right. So all this, I mean, there's so much. I think we need a plan, right?
Yeah,
to
absolutely.
figure out, where's the money coming from? Is it coming from my own savings? And then I have the FHSA as a savings tool, the home buyer's plan, and mom and dad, the bank of mom and dad also available. So I've got my down payment, all right? I've seen the house. How do I know that the bank is going to approve me? In terms of, I've heard of this concept, income versus debt ratios. So what else, what are they looking at?
So there's two ratios, the GDS and the TDS. The GDS is the gross debt service, and then the TDS is the total debt service. So these ratios, I talked about this on the last podcast with David, and the numbers that you should always keep in mind is 39, 44. So 39 is for the GDS, 44 is for the TDS. So what this all means is that it's basically the affordability ratio, right? And then the TDS is the one that's total. So it includes like your debts, your other debts and stuff as well. But essentially, we want to stay within this boundary, below 39 and below 44. That's what the lenders, the A lenders specifically are looking at. There is flexibility. I don't want to guarantee the flexibility of going over, but there are circumstances where, with the right sort of strategy, the right explanations, it makes sense that, you might have, it's 44.03, right? And it makes sense. And then the lender will approve it because whatever situation that's happening here with this client, they can afford to create what's called an exception for this. But if we're going to go under 20%, there's zero exception. You need to hit this ratio based off of your income and then the expenses of the property, plus you're also the debts that you've accumulated as well. These ratios, they are different for B lenders. B lenders can go up to 50, can go up to 60.
I've heard,
right?
yeah.
And privates as well. They can go up higher. But we have to keep in mind that even though they can go higher, we have to also keep ourselves protected as well.
That's right.
Because being qualified for a mortgage doesn't mean that you still have the same funds for your, savings, vacation, retirement.
Yes.
Right?
Yeah.
Which is what your expertise is in.
Exactly. So it all has to fit to a plan. I've seen people, you're right, they've been approved for, like, say, $3 million.
Yeah.
Doesn't mean that you're going to go and buy a $3 million home. You still want to stay within your budget, right? So to make sure that, that you're able to do all the other things. So one of the things you've said, the 39 to 44%, that's a percentage of your gross income, right? So if we're at the borderline, then we probably want to look at reducing debt. What would you say? Should I put more towards the down payment or reduce my debt to qualify?
That really depends, right? It depends on what the debts are. The simple answer would be, when I'm looking at a file, I ask for everything up front, right? I even look at the Equifax report. That's the free one. That's the soft check one that doesn't impact credit score. So I can look at these trade line items. So I know what to expect. Because if I don't look at these things and we pull the credit for real, they pop up. It ends up impacting the ratios, right? So if I have an idea already of what it is, if it's a car loan, for example, car lease, it's not really likely that you're going to be able to pay that thing off, right? If it's like if it's an OSAP, right? You might not be able to pay that off right away.
That's right.
So it's the simple answer would be to put more down, but also be proactive ahead of time. If you're going to be buying a house, make sure you don't take on more car loans, and maybe you don't dig too deep into lines of credits unnecessarily, because those things will impact your score a lot. Your spending you can control. Maybe your income per se is not as easily controlled.
That's right.
Annual performance reviews, right? Like those kinds of things. Like they come once a year. You can't really change your salary.
Yeah.
And also it depends on if you leave as well, if it's related to your industry, if it's like a lateral move or promotion, right?
Yeah,
Or you're
yeah.
completely like leaving the industry that you're working in.
Yeah.
That impacts not just the income, because your income might be higher if you leave the industry.
That's true.
But that sort of like longevity in your career path or in the same industry, that's important. That's something to keep in mind as well.
Oh yeah, because it helps with your credit score. So you don't want to be seen to jump from job to job, from employer to employer.
It helps with like security with the lender more in that regard, because they know like, hey, Pierre, you're working in the financial services. Your next job is not something in construction all of a sudden, right?
Yeah.
So it kind of has like this
stability.
That's right. So those are important things to keep in mind. And your credit too, keep in mind too, not just paying your bills on time and making sure you have utilization, meaning that let's say your credit limit for your credit card is $5,000. Let's try and keep it around, let's just say like 10 to 15%.
Yeah.
Right?
Yeah.
Don't go crazy and spend like high limit up
Or
to
over
the limit.
Yeah.
That impacts your credit score as well. So there's a lot of things that are within your control that we need to keep in mind.
Yeah.
Right.
And then another thing in terms of mortgage affordability is, I may qualify for X amount, but what about the mortgage stress test, right?
Good point. So we have something here in Canada called the mortgage stress test. And basically whatever your rate is, they calculate a stress test, so 2% above that. And if you like qualify with that, then obviously it's a good protection mechanism, right? For both lender as well as borrower. Because you have like the lender will, if they're willing to lend and you're okay in that stress test scenario, then it's safer. And for you too, right? Because you want to know if it goes up, can you still like afford
Exactly. And we're seeing now with what's happening in the world, right? The market's interest rates are going up and down. So, by the time of renewal, what would happen? Would you still be able to afford that house, if rates were to go up by 2%? So that kind of, for me as someone that has a mortgage, it makes me feel a bit more comfortable that with the increases in interest rate, I would still be able to continue to afford my house. So, so the mortgage stress test, you're right. It's for the lender, but it's also for the borrower. So kind of in closing, what would you think the biggest mortgage mistakes that you've kind of seen, that people have done, with regards to maybe the first time buying a home, fixed versus variable, all those things?
Well, I would say this, the one thing that everyone always does, and it happens very commonly with first-time home buyers, is just underestimating your closing costs, right? Like, you've never closed a mortgage before. Did you know that you need a lawyer to do your papers?
I didn't. Not the first time around.
Not the first time around.
Yeah.
So that's an extra, we'll just say, depending on the fees of your lawyer, let's just $2,000 to $3,000, depending on your lawyer. Also, appraisal. Sometimes you have to pay for the appraisal. Also, inspections. We talk about inspections. In a hot market, you might not be able to hire the inspector beforehand. You might have to get the inspector after. But regardless, you need to pay for an inspection to come in.
Yeah, and I heard you last week. I would not buy a house without an inspection. I know before we zeroed in a property in Barrie, we were looking at homes in the Windsor area, and we were ready to pull the trigger 3 times on 3 properties. The inspector came out and said, "You know what? There's UFI in that house. It's a carcinogen, and it you will develop various cancers as a result of that." So had we not had the inspection, we would have been forced to buy the house and remove the UFI out of it at the time the cost was about $50,000 to do that. So I would strongly suggest that you do go with the inspection from this side, unless you're hands-on and you know about buildings and building codes. I would strongly suggest that you do the inspection. So having said that, we're not gonna learn everything this week. In closing, Kev, what would you want to impart on our viewers out there as to?
But just to keep in mind that we have to remain very optimistic and positive always, right? Right? What do they always say? Pessimists sound smart, but optimists, like they're the ones that make the money, right?
Oh, I never heard of that. That's good.
They're the ones that get the results, right? Right? They're the ones that actually achieve things. But pessimists always sound smart, right? We have to realize that yes, there's turbulence in the market today, a lot of uncertainty, geopolitical issues, yes. But keep in mind, no matter what happens, things always, like humanity does find a way somehow.
Yes.
So yes, if you're getting ready to buy a property, keep in mind the only things that you have control over are your expenses, how much you save, so you can contribute that towards your down payment. You put it into your savings account or TFSA, anything like that. We can't control how much it goes up or down, but your spending and your the money that you're able to save, that actually has more control for you than you think. So keep that in mind. And we've talked about saving before.
Yeah, we did.
That's important.
Yeah, you're right. And like you said, paying down the debt is also important. Stay within that 39 to 49% GDS and TDS ratio. So yeah,
39.44. That's a magic number.
That's what that's what I'm going to remember from now on. So, well, we hope that you found this informative. I know I've learned again with Kevin here, 39.44. And thank you again, Kevin. And thank you, everyone. Don't forget to like and subscribe. And between dollars and dreams, this was another episode from the TF team. Bye for now.